Should I switch my super from high growth to stop the bleeding? Whew, what a question. Hi all. I have a super balance under 200K, which I've seen drop by 3.5% over the last month. All 100% invested in high growth with rest. Should I change to cash/low risk and turn high growth back on when things are more stable? I'm 33 years old and I can't see me retiring till age 65. One thing I did do, Johnny, for this chat today, I thought, let's go to Reddit and get some questions.
Reddit?
And this was one of the questions from Reddit. That's why it's anonymous.
All right.
And then secondly, there was another question. What are you doing with your super portfolio mix with a pending US recession? Now, I will say at the time of recording, we record this a little bit before they go up. There is no US recession.
Nope.
And that doesn't really matter for the sake of the discussion today. But we'll just say at the moment there is no recession, and I'll tell you why it doesn't matter. This next question was, currently my super is in a pretty standard balanced portfolio with Host Plus. I've seen a little dip, which I expect over the next 6 months only to get worse. Is anyone shuffling their allocations to a more shielded asset, thinking along the lines of property, infrastructure, fixed securities, etc., which will likely be less impacted in the short term? Or is it not worth it and be better just avoiding reviewing your balance for the next 6 to 12 months, knowing it'll sort itself out for the long term? A lot to chat about there. John Pidgeon from the This Is Property podcast. Any kind of high-level comments before I get into the weeds of this? Because I've actually brought up the Rest website here. I've got the Host Plus website. I'm going to have a look at some of these investment options.
Interesting, isn't it? That I suppose when we're delving in that asset class, we tend to maybe look at the performance of it on a more regular basis. Is my
What asset class?
Shares generally?
Okay. Yep.
Yeah, not property.
Yeah. Okay.
Property we set and forget, don't tend to look at as much.
Yeah.
We can analyse that performance daily and see the dips and ebbs and flows and everything else. So that can bring some emotion into it, short term, long term.
We see these prices daily, right? And it's a good question. So a question for you being the property guy, like you've got clients that you coach on an ongoing basis, right? Do you get these type of phone calls? I've heard West Brisbane or North Brisbane or South Perth is going to be rocky. What should we do? Like, what do you answer to that?
It's probably the same answer regardless, isn't it? It's like, well, okay, like this example of 33, retire at 65. Like it's got 32 years to correct itself and continue to perform. So I think once we start messing around with it or looking for the timing of something, we tend to maybe trip ourselves up. So we're always relating it back to, well, what do we expect the long-term outcome to be for us and our finances? But, I just say, look, we need to play the long game. And if it works for you and your strategy, then fantastic. But don't try and chase the short-term wins or in this case, maybe losses. In one of these examples, okay, so we get out of that asset class, what's guaranteed that the next one we get into is going to outperform?
And I think I want to maybe, and I'll say full disclosure, I'm going to make some comments here that are going to be a bit provocative and fun. And, you know, as someone said to me the other day, you put the icing on thick sometimes, Glen, but we know you're joking.
But do we?
Probably not. That's right. So a couple of things. Should I switch my super from high growth to stop the bleeding? This is the Rest high growth guy. 3.5% over the last month. We've had big sell-offs. Remember, there has been we're coming off all-time highs.
Yeah.
S&P 500 all-time high. ASX 200 all-time high. Generally what happens when you see the little up and to the right type. See, I'm doing it in reverse for the camera.
Yeah, you are. It's very good.
When you're going up and to the right, you see this sawtooth. And it's like a yo-yo walking up backwards. Past performance is not an indication of future performance.
No.
But,
Good
Johnny,
starting point.
I reckon it kind of is if you step back. So if you step back, Great Depression, oh my gosh, market's tanked. You step back. I'll fast forward a lot. Or maybe we'll talk about like the oil crisis and the Cuban Missile Crisis and all this stuff. Then we look at .com 2000 bubble.
Yep. Now we're alive.
Welcome, we've been born.
Yeah.
Big drops, big shocks in markets. We look at 9/11, that was a big one shortly after. Then the GFC, huge. COVID, look at an ASX price chart. COVID, bam. Now, bit of a recovery since COVID. Things are going well. Crazy orange guy is in the White House and things are getting crazy. And my hypothesis is things based on history have recovered. And my question to someone asking this question who is 33 years old, who can't see me retiring till 67, or 65 rather, they can't pull out the money anyway until 60 and stop working.
Yeah.
So I'll go out on a limb, the best part of 30 years to have this money invested. So I'll have a look at this. So I've pulled up, and if you are watching us on YouTube now, the 3 followers that we've got, because we're really trying to build that different audience, I've had a look at the Rest Super High Growth Investment Option because I just wanted to step back and have a look at this.
Yeah.
And I like it that someone is interested in like, oh, what should I do? I'm online. I know that things I'm looking at it. Number one, we shouldn't or don't need to look at our super balance weekly or monthly. Maybe yearly you might review. Okay. I'm on the Rest High Growth website. The minimum suggested time frame to hold the high growth fund with Rest is 12 plus years.
Right.
And that's high risk. I think it's probably a sidebar, but it seems like a 12 plus year hold time, that's some stuff going on in that portfolio. We're saying we've got to hold this for 12 plus years.
Yeah.
Most equities, like if you, and I will have a look in a second, just remind me, I'll actually write it down, index option, because we'll just have a look at just a bread and butter equity fund, what they say the minimum hold time is, right? So we know that it says the high risk, the risk is high. So if we go back to old mate here with 33-year-old, can't touch it anyway, wants to know, do I pull this money out, wait, then reinvest? No, we don't, because we're not portfolio managers. We know that when we invest, so old mate here he's going in every month, every quarter, knowing that every time a contribution goes into the fund, we're saying out loud that this money needs to sit in there for 12 plus years.
Yeah.
And because when they manage the portfolio, their modeling says, look, there will be times when Trump comes in. There will be times when COVID hits. Remember, COVID and Trump, it's happened within a 12-year period, hasn't it?
Yeah. And I think even if this example has held it in there for 12 years and you could get it out, it's a short-term approach, isn't it? It's still not playing the long game because we're 30 years till we can actually or need it. But if someone was sitting here with this same question at 58 or 60, right, and then we've got a pending crisis on our hands, we've got maybe a different conversation, but we don't want to act with I suppose we don't want to act with emotion straight away, do we? Yeah.
So let's have a look at the asset allocation of the portfolio that old mate's in. Overseas shares, international shares, 47.5%. Australian shares, 32%. Property, 6%. Infrastructure, 8.5%. alternatives 1.5, and debt 4%. So basically, the asset allocation is 90% growth.
So 47 for international. So
Yeah.
that's where Trump's having a bit to say about that at the minute.
Well, it's just dicking around with international norms and whatnot. Let me just bring up VDHG. So the VDHG is a high growth index fund, which is a one-stop shop. We know that fund is also a 90-10. Their international exposure, international shares, about 42%, plus 6.5. So yeah, in terms of just having a quick comparison, I should have done this before, but I'm just wondering if there's a minimum.
It's about half.
Yeah, what they say is the hold time, because it's just more of a question when you have superannuation, you really, or any investment, you want to actually have a look under the hood and what they're investing in. Okay, so here we go, about to find it. Vanguard Diversified Growth Index, their minimum suggested time frame is 7 years. Vanguard Diversified High Growth ETF, their minimum hold time is the Vanguard Diversified High Growth ETF. Mind you, a 90% growth, 10% defensive, their minimum suggested hold time is 7 years. So my question to the good people at Rest, with your high growth fund of 90% growth, knowing that the 10-year return is 8%, 12 plus year hold time, equivalent equities, what the heck are they doing with that infrastructure and property exposure? Because to me, that's a very risky fund. I don't know if I'm personally going in a fund like that.
Well,
not sure. But when we look at a pure equity play and listed, Vanguard, dare say they've been around longer than Rest.
Yeah.
They've worked out that a minimum suggested hold time is 7 years versus this 10. And I will,
12.
versus this 12.
Yeah.
And just as it's not complete apples for apples because of the taxes with super, but the 10, I can't see the 10-year, but the 5-year return, the 10-year benchmark for the fund of the Vanguard Diversified High Growth is 8.97. So very similar return.
Over 10 years. Interesting why
with a minimum hold of 7 years.
Yeah.
I don't know. I just think it's fascinating. And that's why I want you to, whatever super fund you're with, just check it out. Have a look. I'm sure there's other products that Rest have that have a lesser hold time.
Yeah.
Rest that they may even want to work on this podcast and, sponsor us and all that one. And I probably would because on balance, good fund and all that.
Yeah.
But it comes down to looking at the individual investment options.
Yeah, and my thoughts would be majority of your investing needs to be a long-term approach anyway. You might have a small portion that says, okay, we can go a little bit more speculative here and bring it in and out of different funds and everything else. But generally, the bulk of your investing needs to be a long-term, non-emotional, solid approach, doesn't it?
100%. So what I'm saying is no, we're not. We're just keeping it. It's more of a discussion. Are you comfortable with that option? Because if you sell now, what if you miss a rebound, which most people do, you're going to actually lose money because you'll crystallize the loss and then you'll be buying in at a higher price.
Yeah.
And remember, it's not sell high. It's not sell high,
sell low, buy
high, or sell low, buy high, because that's what this person would be doing, right?
Yeah,
it's
that's right. It's the other way
sell
around.
high, buy low.
Yeah. If we gave a property example though, like we would ask the question of, is the asset class reliable for the long term?
Yeah, and the answer is yes,
And
right?
the answer is yes in here. in this example. But when we look at certain property types or locations, the answer to that is no. So that's when they could make the decision to say, well, I'm going to sell out. But in this example, 8.55 every 10 years or something, isn't it? So you'd say, well, yeah, that's a consistent performance. So why mess with it?
So an example, if we go to old mate's question, what are you doing with your super portfolio mix with a pending US recession? And this is where I'll get cheeky. This guy has heard that there could be a pending US recession. There might be, whatever. Smart enough to know that it could happen. Smart enough to know that this is happening, but actually doesn't know enough to make good super decisions. And that's why super funds have pre-mixed portfolios. And we don't want to get our mitts in there and start dicking around. We just need to leave it, because old mate's like, is anyone shifting their or shuffling their allocation to more shielded assets?
Yeah.
Your portfolio has already got property. It's already got infrastructure. And, do you want to have any comments there?
Yeah, I think maybe they're just fishing for people's thoughts and opinions.
Yeah, I get that, yeah.
Because they've said, on the other hand, or is it not worth it and just better avoiding the reviewing of it? Like, that's definitely the answer. But maybe if we're fishing for, okay, who's got some other thoughts on this pending recession that I can get my hands on?
So now if we go to, I'm just going to open the the Host Plus website, right? So I've looked at, old mate says he's in the balanced fund. They're saying the investment time frame is 5 years plus, right? The growth allocation is 76/24 defensive. The allocation to international shares is about, we'll call it 30% at the moment is the target.
Right.
So we know that we've got, 24% defensive, 76 growth. Now, when we actually look at, and again, I'm not saying this that we make decisions based on performance, but it's just good to know, okay, this is the asset allocation, this is the risk profile of the fund, this is the suggested hold time, and this is what it's done over the last 10 years. It's just good to look at that insight.
Yeah.
It's fascinating. So if we have a look here, this is equivalent to the REST fund, and we haven't even talked about fees discussion yet. We're just looking at asset allocation. He said he's in balanced. The last 10 years, 8.04%, where the high growth fund with REST did 8.16. So basically the same. So we know that when things are rough and you basically, with your investing, I'll try and do this. You can have a smooth ride like this flowing up and to the right, or you can have sawtooth.
Yeah. Bumpy.
So this fund, less risk, basically the same return because it's the asset allocation. Now, if we have a look at the, we've looked at the index hold time, they've only just done, they don't have data on Host Plus's high growth fund over 1 year. It must be a newer fund. But I think all I want to encourage everyone on is to work out your strategy. Oh, and actually, here's one here. 10 years indexed balanced, 7.24% with Host Plus, which is the index balanced that it was very popular in it, one of the most popular selling books in Australia. Everyone go to Host Plus, put index balance, it's the cheapest fund in Australia. Where if you actually went the active growth fund, 8.9% after fees over 10 years versus the index balance, 7.24% after fees.
Yeah.
If you paid more, would have got a higher return.
Yeah.
But what? How does that work? Well, it's all got to do with the asset allocation in the super fund. So within all that, Johnson,
Don't mess with it.
don't mess with it. Understand your investing time horizon. Understand what you're invested in. Understand that when we basically have forward-thinking strategies, over the next 30 years, we know that there's going to be corrections in markets.
Yeah.
We know that it's going to be up and down. We know that this is going to happen. And that's why we say, yes, I can invest in this over the next 10 or 12 years because I don't need the money now. And the portfolio manager is saying, hey, stick with us for 12 years because there will be ups and downs.
Yeah, it's a rocky road. But I think when maybe investors or anyone out there, mums and dads, look at these returns here and say, well, it's 7.64, and then they say, well, year two, I've only been getting 3.4, they start to question and potentially go and make these short-term mistakes.
I mean, the biggest crime with super funds and advertising, like on this website, I'm just having a look here, net return, well, I'll just pick on REST. The corporate affairs, probably you've scanned this and picked it up, so high REST. Why are we heroing 1 year returns with superannuation funds? Because we're tapping in to people seeing that, 11.24% 1 year return, that's awesome. No, we're not looking at 1 year returns. I only look with super funds, no less than 5 year return if I want to look at performance, because the portfolios are managed in different ways.
But like how often should you review that?
Well, I think it's a broader question about financial planning and your strategy. Like with my super, I honestly think we just run our eyes over it yearly.
Yeah.
Like we know old mate's portfolio is down 3.5%. Guess what? His employer contributions, when they're getting invested, they're buying the asset at 3.5% less than it was last month.
But running our eyes over it annually doesn't mean necessarily changing it, does it?
No, it's just being aware of what we've got.
Yeah, because if we're changing it annually, we're in for some real tough times.
Yeah, we're just not doing it. It's just long-term strategy. But anyway, we will move on and should we start the podcast now that we've done the A block?
We're into it.
All right, let's get it on. You're listening to Money, 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 or as the regulars like to call it, M3. We're Australia's OG personal finance podcast. Everything you hear on the show is general advice only, which I'm licensed to give, and details can be found in the show notes. My name's Glen James, former financial advisor, now podcaster. I've got a book, The Quick Start Guide to Investing, and I host, produce, and curate this podcast with you in mind. You can follow me on Instagram, just search Money Podcast, or if you want to join the Facebook group, just put this episode number on your way in so we know you're real and not spam. Otherwise, thanks so much for listening. Let's do this. Here's one that you might be able to help with, John. Again, this is all from Reddit today. Looking for advice? Are we doing okay? Married couple with one kid and a 500K mortgage in our early 30s. We have about 100K in our savings and 10K in an emergency fund. No debts apart from the mortgage. I work in healthcare and my husband in the police department. What do we need to do more to improve our financial situation? I'm thinking of getting an investment home in Melbourne. Is that a good idea? Or should we start paying our mortgage sooner? We're both very proud to be in this financial position right now, which came from both hard work and perseverance. We don't budget, but I feel I can do better in managing our finances. Any advice would be appreciated. Thanks. What are you saying to the questionnaire?
Well, it's a very, I suppose, cookie cutter situation, isn't it? For a lot of people around the country, they've got themselves a mortgage, they've got some savings, they've got an emergency fund, which is fantastic. Generally, they're doing okay, as they've said in the heading. They probably want to sharpen up their, I don't want to call it budget, but their cash flow management plan.
Well, you've got to have a budget to sharpen it up, and they said they don't have one.
So they've got to actually know and forecast, well, okay, this is how much we're going to save this year based on what we can do in our life and want to do in our life. Early 30s, so plenty of time to go and buy investment properties, etc. We'd like to think that the 100K may be sitting in an offset account against the 500K in debt.
Yeah.
So we're paying interest on 400 instead of 500 daily. That would be good unless we want to do something else with it. But for now, we're saving probably 6% in interest. So the issue I have with this, Glenn, is this person has gone to location first in their strategy. And they're saying, right, I don't know where they live.
I would assume Melbourne.
Yeah, let's say it is Melbourne, because generally what a lot of people do is they want to look locally as their investment. Not sure how much they want to spend. Not sure what sort of cash flow they want. Not sure what type of property is going to be best for their strategy and their portfolio. What is their long-term outcome for this property? But we're going to location first. So we need to scrap the Melbourne thing first. Not say we won't go there, but let's work out, well, why do we want to buy property? Okay, we want more in our life. We want to pay down the mortgage sooner, which we can do by having a solid savings plan, build up the offset account, have flexibility with higher cash amounts, and then recycle the equity back out and go and buy an investment property. No problems with that, absolutely whatsoever. But we just need to plan it out a bit more and say, well, okay, we can't say off the bat Melbourne is a good or a bad idea because we don't know enough detail yet.
But even one step before that, we don't know off the bat that buying a property is a good idea. We don't know off the bat if investing in super as a salary sacrifice is a good idea. We don't know off the bat if just paying down the mortgage is a good idea.
Well, generally speaking, paying down the mortgage is always a good idea. But I think second to that, if you want to go and buy property, you've got to have the want and the desire to do so, not come kicking and screaming to it just because we think it's a good idea. So it sounds as though we've ticked that box. And if we've got regular incomes and equity in our home, we're probably going to be able to lend money. So conceptually, we're there ready to maybe go, but we just need to design a strategy.
Yeah, so the TLDR, looking for advice, are we doing okay? The answer is yes.
Yeah.
Now, I'll make some observations in finishing. We have 100K in our savings and 10K in emergency. Now, if you are in healthcare and your husband is in the police, I'm probably saying there could be around 200K household income. I'm then probably saying that based on that, and I don't know how much people spend, that the emergency fund of 10K, it might be a little bit shy. It might need to be 15 to 20, but that's here nor there. I like the fact that she's talking in her comments, because we see this, like someone says, I'm married. I want to do this. I want to do that.
Yeah.
I'm doing this. Husband and wife as the passenger. She's used the we.
Yes.
Yeah, we want to do this. We want to do that.
We've spoken about it.
Yeah. So what I would say is she said we don't have a budget, but I feel we can do better at managing our finances. The Glen James spending plan. If you don't have it, it's just really easy. You can jump in, go to education.moneypodcast.com.au or just Google the Glen James spending plan. It's the first hit on Google, and that will allow you to at least get a spending plan in place. Then what I'm doing is we're working backwards. We've put all our expenses in there. We've put our income in, and that plan will just help you work out how much is left.
Yes.
At the end of the month, end of the week, or whatever. At that point, we have a discussion with each other. In 5 years' time, what do we want our life to look like? Oh, it'd be so good if we just owned this house, felt good. Or in 5 years' time, we want to start a business and I want to do this. Or in 5 years' time, it'd be sweet. We've always wanted to buy an investment property. In 5 years' time, we wanted to say that we went to Europe for 3 months or something like that. So I think it is that goals thing. Yeah. You're doing fine. I think everyone needs some type of spending plan or budget because everyone has income, everyone has expenses. Yeah.
And the other part of it, to finish on all of that, we're very proud to be in this position financially. that's an important aspect of it, isn't it? Is to smell the roses and say, yeah, we've actually done pretty well here. We've got to appreciate that before we just continue to move forward, because sometimes we go searching and driving and getting all motivated about something, but forget actually what we've actually been able to achieve, and we lose sight of actually why we're doing it.
Yeah. And that's it. Like, I'm thinking of getting an investment home in Melbourne. Is that a good idea? Well, maybe, maybe not. Contact John.
But I would say Melbourne's an interesting market at the moment, and we won't go into too much detail, but it's on the nose generally in Victoria right now with the government and introduce land tax and higher stamp duty. But affordability in terms of what you can buy down there for the money you've got compared to, say, the other largest capital city being Sydney is outrageous. So we'll watch this space there.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia so they can connect with you wherever you are. That's moneypodcast.com.au and click Get Help.
Before we get back into the show, I'd like to encourage you to protect your financial life. Now, what does that mean? It means having income protection insurance in place. It means having death cover in place if you do have debt or dependents. It means having your suite of personal insurances sorted. I know you insure your car. I know you insure your house. Why not insure you? I really want to encourage you to reach out to Sky Wealth. They support the podcast. They are specialist financial advisors who can look at your situation, walk through a heap of options personalized to you. It's usually far more comprehensive and competitively priced than going direct to your super fund. You must see a specialist financial advisor for your insurance. You can head to sky.com.au, that's skye.com.au, to book a complimentary 15-minute chat, and the team can point you in the right direction. Like all good cults, we need a place to hang out together. That's our Facebook group. If you are going to join the Money, Money, Money podcast Facebook group, just put you heard about the group through the podcast and put this episode number that you're listening to. That way we know that you're not a spam account. Otherwise, you can catch me on Instagram at moneypodcast.aus. Thanks so much for listening. Thanks to Sky Wealth. Let's get back into the show. Okay, we asked the Facebook group, if you've got an unexpected $10,000 today, what would you do with it? And we did a bit of a poll, if you will, Johnny boy.
Yeah.
36% of you who filled it out said invest it. 28% said pay off debt. 14% said put it towards home improvements. Save for a specific goal. 14%. 7% take a holiday. And then 1%. Said other. Christy said offset account. So effectively just hold.
Yeah. Jenny, helping the kids and giving some to my charity. That's important. Well, you could say both of them are charities.
You could. Robbo, create an emergency fund with like the kind of wet eye emoticon, like whatever you call it.
Lauren says put it towards kids' school fees.
Get one or 2 years out of that. Julian, put some of it, split some up, 5K in savings, 2,500 in emergency fund, 1,200 into debt and investing. So there you go. What would you do with 10?
Well, I was actually going to ask you that first, but you beat me to it. I'm sort of doing this now, to be honest. I didn't have a spare 10, but I'm spending 10. A lifestyle-wise, ice bath.
What are they worth?
Give or take, 5-ish.
The ice bath's $5,000 because it's got a refrigeration unit that cools. Okay, so you don't actually have to put physical ice.
No, correct.
Okay, so it's a refrigeration
and filtering system, all the bells and whistles, and a pizza oven for the deck. So
when you get that pizza oven, you invite me over.
You'll be first on the invite. What are you doing with it?
Oh, I'm probably just putting it as savings / offset account.
Yeah. Got everything you need.
And I think it's important to always have, when we get to a position with our financial affairs and with that question of like, okay, if $10,000 did come in today,
Yeah.
to not actually, I need this or I want this.
Yeah.
And I think, I've got what I need at the moment.
Yeah.
But I've got the philosophy, because I don't need anything at the moment, I would put that $10,000 on an offset account as dry powder if a future opportunity came up.
Yeah. No, that's a good idea. And it's an interesting question, isn't it? Because your time in life is an important thing, but and we back end that question from the property. It was like, well, why are we doing all this? And sometimes smelling the roses is a good thing, but not smelling the roses when you're 22 and you've got bad debt and all those other things. We've got to be putting it in perspective, right?
So that I think last week or the week before or whatever, I don't know when it was up, in the after party, we talked about the person who got the Powerball.
Yes.
They text me the other day. I'm like, the money landed, all that. I said, amazing. I demand a screenshot. Look at this, John. That's their bank account.
Wow.
30,500,000.
And it's all available.
All available to spend.
That is astronomical.
So they're working with one of our advice partners to make sure things happen early. Because just a sidebar to that, sometimes with ultra high net worth clients, not all the time, they will move you out into a wholesale investor.
Yeah.
Which no SOA, here's 200 grand into this. You lose a whole heap of consumer protections. And I really think it's important seeing a financial advisor, structuring everything, formal advice, no matter how much money there, you're not outside of that consumer protection environment.
Yeah,
so
absolutely.
You do need a statement of advice. Yeah. There's more disclosure and all that stuff. So we'll keep everyone updated of what happens.
Surely a $2 million investment property is in the...
Well, no. I said to the advisor and to the person when I talked to them, I'm like, carve out 5 or 6 million.
Yeah.
Go to John. Tell him you want 5 properties. Because property will be part of their broader strategy. So,
bit to play with.
Yes. All right. In finishing this week, thought I'd give everyone a bit of an update, bit of a breakup story, John.
Ooh, you're no longer with your partner?
No, but that's not the breakup I'm talking about.
Right. What are you referring to?
I had a breakup. One of the property managers that I have.
Right.
With a couple of properties.
Do you have a disagreement?
No, it was more I don't like incompetence.
No.
And for those who have investment properties out there, this is what I want to bring up, because it does flow through, because I want to be the best property owner, landlord that I can be for my tenants.
Yeah.
And, a couple of the properties were managed with one company and it was awesome, it was fine, good.
Yeah.
They sold that rent roll and another business took it over.
Yeah.
And it's just been sloppy for the last 12, 18 months.
Yeah, that old story.
And some examples. And because my whole thing was, if you're not on top of it with me, who's paying you, I'm your customer.
Yeah.
How are you going to be on top of it if my tenants have issues?
Yeah.
How are you going to be on top of it if this financial asset has issues?
Yeah.
So a couple of things, like when they first kind of were doing the call around, and I said to them, I'm like, I get it. It's, it's not ideal, but I'll work with you, because I'm not of the view that one thing goes wrong and I'll end a professional relationship, because I get that things get busy and ball gets dropped. Like, some of the best professionals in the world, there will be little mistakes that just happen, and you've got to have grace. And, I think they dropped the ball 3 times with some issues, but it was more the basic communication stuff.
Right.
They called me one day after I'd been dealing with them, and it was another lady. Hey, Glen, it's so-and-so, just calling about this property. I'm the new manager. I'm like, yep, sweet. Hung up. Next minute, phone call. Oh, hey, I'm calling about this property. I'm like.
You just rang me?
Call her Debbie. I'm like, Debbie, this is the Glen that you literally just spoke to.
Yeah.
So just from a basic one, what the hell are your systems to not say that, Glen James, we have these assets.
Yeah.
Just a bit of forward thinking and looking at the situation.
Yeah.
A couple of weeks later, had a phone call. Hey, it's so-and-so from the same agency. Just wondering, that property there at, Blue Bay or whatever, is, that, are you living in it or is it tenant? I'm like, you guys manage
Collecting
that
the
property. Literally your company that you're calling me from manages that property. And so there was that. There was some issues with, and I think when you are a property owner, you've got to have the view like, I want the places that I own to be upkept enough that I would want to live in there. Fire service comes in, replaces smoke alarm, freaking leaves 2 holes and put it in a different spot in the ceiling.
Right.
And then left. And then I went in, had a look, because I had to drop in or something one day, and I saw it. Like, what the bloody hell? No. You're getting the fire people back out. Get them to send photos when any tradie does work. And the real estate had to send someone out to fix it, because it's like, this is basic stuff. And then there was some other issues, and the straw that broke the camel's back. And there was seriously so many other little things where I've just lost confidence. The straw that broke the camel's back the other day, I got an email. Hey, Glen, I'll read it to you, John. This will be good. And noticing I'm putting this at the very end of the podcast, everyone, because if you've just dropped in and you're new, not good content.
It's irregular content.
It's just for my people who are regulars, all right? So just go easy. I'll just bring this up now, because I just literally gobsmacked. And then when I talked to them, their response, I was also gobsmacked. Is that what they call it?
Sounds like it's death by 1,000 cuts.
Oh, it really was. Gosh.
So how long did you give them from go to woe?
I think 18 months.
Yeah, which is long enough.
Yeah.
It's like a bad relationship,
But you want to have grace and give it time.
Yeah, you give it probably 6 months longer than you need to.
Yeah.
Because you're a nice guy. And
Well, I just don't like disruption and change.
Well,
and I know that you bought this rent roll. It is a bit sloppy. I'll let the dust settle. But the dust wasn't settling.
No.
And I'm like, so this is the level of attention to detail.
Yeah.
Where this was the straw that broke the camel's back on Monday, the 3rd of March. Hi, Glen. Hope this email finds you well. And I didn't.
It didn't find you well.
No, it didn't find me well at all.
That's not their fault, though.
No, it's just me. I'm just not well. The tenants of your properties are due for a lease renewal. Please advise if you would like me to offer them a new 12-month lease. They have both had rent increases, so there would be no inclusion of a rent increase in the lease. Please advise if you're happy to offer them a new lease. And I'm like, Hi, can you let me know when the last increase was for property A?
Yep.
Because in my mind,
it was longer than 12 months.
A very long time. Also, didn't the tenant at property 2 literally sign a 2-year lease at the start of the year that you organised? Hi, Glen. Yes, property 2 is on a 24-month lease.
Wow.
Sorry, not sure why that popped up. Okay, great.
Check.
Property 1, the last increase was on the 4th or April 2024, so a year ago. They are due for a rent increase. I've attached rental estimate for your inclusion. Hang on, half an hour ago, you said they both had rental increases. Now you're sending me a rent evaluation. Get it to freaking together. And I don't know if it's the business or an incompetent person with no attention to detail.
And I think
I'm done. I'm out of there.
Yeah, that's not – sometimes it's their fault in the front end, but sometimes it's not. Regardless, not your issue.
But this was just like – and I've told like literally I'm like, if this happens, like guys – I can't keep going through this stuff.
No.
Like I'm paying. So anyway, I then sent an email, which bounced because they changed their domain and didn't let everyone know. So that was good. Basically got a different property manager. And then this lady called me, so, can we, why? And I'm like, literally the email that you sent last week, you said we're all good here. Do you want to renew? Factually incorrect about one of the properties.
Yeah.
Number 2, you said it didn't need an increase. Then when I questioned it, then you've told me, yes, it does. And I've done a rent review. And she said, oh yeah, sorry about that. But we did provide that rent valuation. You've missed the point, Debbie, or whatever your name is. You've missed the point.
Yeah.
You guys aren't on top of my shat.
No.
I'm breaking up with you.
Yeah, look, fair enough. Fair grounds, I would say.
So imagine, and this is where I really get annoyed, if they are dropping the ball with me, what if one of my tenants have asked them if there's an issue?
Yeah.
And one of the tenants was like, oh, they won't friggin' fix it. It's been, a year since we reported it. Like, it then makes me as the property owner look bad.
That's right.
And I want to look after my tenants because I rent as well. And believe it or not, people who rent, they're just people like the next person.
Yeah.
And if you look after good people should look after you.
Yeah. And they're paying you're paying good money for that service, like 7-8%, whatever it might be. So that aside, you've got to have a level of expectation as to what you're getting with a service, any service generally. So
and I think as well, as just a human to human level, and I said to this woman, I said, look, it just looks like to me you property managers got too many properties.
Yeah.
Because on a human to human level, with all the issues that we've had over the last 12 months, with all this toing and froing, Debbie should know that Glen James is that guy who has these 2 properties.
Yeah. Yeah, and that's one of the questions that we get our clients to ask is how many properties do you manage and how many property managers have you got managing them?
Yeah. So I basically I used this time, I pressed reset and moved all the properties to one agency.
Right.
So I got a good deal and, I'm happy.
Watch this space.
Yeah. So, but and that's it. Like, I hate disruption in my life. I hate change. I hate paperwork. I hate all that stuff.
Yeah.
And that's why I'm happy to give grace for a few months.
Yeah.
For a year, like over 12 months, maybe 18 months.
Yeah.
And I said, you've just lost thousands of dollars worth of work. I said to her, I'm like, if the practice owner wants to call me, I'm happy to give feedback.
Yeah.
As a fellow business owner,
Yeah.
I'm happy to do that. Rach Kroon from Sphere Home Loans, who, she's on the podcast and all that, I think she's had to move properties from them.
Right.
Emailed the practice, they didn't care. And it's like, okay, if you don't care about people, that's your number one job. If you have a business and you look after individual people, your number one job is to actually care and make sure they have a good experience. This is different if you own a software as a service solution, it's all in the back end and all that. But if you're consumer facing and you're charging a fee for service, and this is easy money, my properties are easy money. Locked out someone in for a 2-year lease.
Yeah.
It's easy.
Yeah. And generally it is easy money if they pay their rents on time and
got good tenants.
There's no issues.
But if you are running that business, it just you lose thousands and thousands of dollars when you don't look after people, you don't prioritize, you're not consciously aware of your customers.
Well, I think it's maybe not even that, is it? Sometimes it's just they're doing their job, but the job hasn't been properly systemized, or they're just not appreciating the 1%ers.
And it could be interesting. Like, I think when I had my financial advice business, I would have had more clients than an agent would have in their rent roll. Like a property manager, what do they say, like 80 properties or something?
Per property manager? Maybe. I've seen them much higher than that, but let's go with 100.
Like, I may have had 200 or 300 clients or whatever.
Yeah.
I intimately knew all their details and remembered.
Yeah.
Like, I see someone, like, haven't seen them for 4, 5, 6 years, set up an income protection policy for them 10 years ago. How's that knee going? Still giving me trouble.
Yeah.
Again, weird that I remember intimate quirky details about
Yeah.
everyone. And I'm good with faces and names. Like we'll go to an event.
Yeah.
I met someone inboxed me in Instagram,
Oh, yeah.
and because I was doing this studio stuff, and they're like, "Oh, hey, I work in TV, and if you want a hand with your lighting and all that in the studio," I'm like, "Have I met you at an event?" He's like, "Yeah, I was at the property event last year." I said,
right.
"Oh, and your wife is the producer?"
Yeah.
He's like, "Yeah." Like, I don't know. I'm a freak with that stuff.
That's good.
So-
Yeah, it's a good quality. And I think the best property managers I can recall and still have, one of them today is they're normally ladies, I find. The ladies that are middle-aged that really care. They have good memories and they just go to the nth detail with everything that they do. Unfortunately, a lot of people that come through the system are young and are maybe not taught the right way to
Yeah, but
actually
imagine
run.
a new entrant into an industry who's a really good quality person going in and learning from someone like my property man. Like imagine
Yeah.
this company that I used on the coast. Imagine a really good young
Yeah.
person wants to be in property, wants to be in rent roll, wants to be property management, coming in and learning all this crap.
From this one.
You would
Yeah.
hope that they would be smart enough to go, all you people are crazy and don't have a memory and your systems suck.
Yeah.
But what if they're getting trained bad habits?
Well, yeah, and the best way to understand someone's knowledge is to get them to teach it to someone. But
Yeah.
interesting. Anyway,
So that is
we've had a
the
breakup.
breakup story.
you go.
Sorry, it was a bit of clickbait, but
Yeah.
we're here now, and looking forward to doing some more episodes. We'll leave it there. Thanks for listening. Really appreciate it. We know you've got a choice, and thank you for choosing us. My name is Glenneth Jameseth, and this guy is
John Pidgeon.
Earth.
Earth.
Bye. Thanks for listening to today's podcast. If you want to support us, there is one way you can do that. You can send the episode to a friend, a family member, or your group chat if you think those people would find it valuable. We also thank you for leaving a review on Apple or Spotify. If you've listened to this podcast for some time, or if you've read any of my books, you would know that giving and generosity in a financial sense is a big thing in my life. If you think it's time that you are ready to give financially to a good cause, you could head to our website, moneypodcast.com.au/charities to see the charities that we support.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the product disclosure statement, PDS, and target market determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorized representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.